What if the biggest shift in crypto right now isn't happening in price charts, but deep inside legislation, institutional strategy, and financial infrastructure? Because in the last few days, three major developments quietly happened that most people still haven't connected. Congress just moved to block a Federal Reserve retail CBDC until at least 2030. A leading institutional analyst revealed that crypto is currently sitting near one of the lowest valuation levels in the last 8 years, and cross-chain settlement technology just accelerated dramatically, dropping from minutes to mere seconds. Individually, these might sound like separate headlines, but together, they point to something much bigger, a structural shift forming beneath the surface of the market. And if you feel like nothing is happening in crypto right now, the truth is you may simply be looking at the wrong layer because the real signal isn't on the surface. It's in the architecture being built underneath it. Welcome back to Stack Smart, the place where we focus on the structure behind the market, not just the noise around it. In a space where headlines constantly distract investors, the real advantage always belongs to those who understand the system before the crowd does. And today we are breaking down four signals that are quietly converging to create one of the most interesting setups we've seen in this cycle. Let's begin with the development that is receiving almost no attention in mainstream discussion. A provision has appeared inside a major housing bill in Congress that would effectively prevent the Federal Reserve from issuing a retail central bank digital currency directly to consumers until at least December 31st, 2030. At first glance, this might sound like a political detail, but structurally, it could be extremely important for the future of private stablecoins, particularly projects like RLUSD. For years, the biggest potential threat to private stablecoins has always been the possibility that the Federal Reserve would eventually release its own digital dollar. If that happened, privately issued alternatives could become largely unnecessary. But if legislation blocks the Fed from launching a retail CBDC for several years, something interesting happens. It opens a protected window where private compliant stablecoins can grow and establish themselves within the financial system. RLUSD appears to be positioned almost perfectly for that environment. It is structured as a fully backed digital dollar, supported one-to-one by reserves such as US dollars and treasury assets. It operates within a regulated framework and is designed specifically for institutional use. In many ways, analysts describe this model as a type of synthetic CBDC, privately issued but structured in a way that integrates with the existing financial system. When governments decide they do not want central banks competing directly with the private sector in the digital dollar space, this type of structure becomes extremely attractive. And that's why the legislative architecture being discussed in Congress and the financial infrastructure companies have been building for years suddenly seem to be pointing toward the same destination. Now, here's where the XRP ecosystem becomes part of the conversation. A compliant stablecoin operating on the XRP ledger increases liquidity and accessibility across the entire network. Every institution that adopts RLUSD for settlement effectively becomes a participant on that ledger. And once institutions are connected to that system, XRP itself becomes a natural bridge asset when payments need to move between different currencies. In other words, the benefit isn't limited to one stablecoin. It strengthens the broader ecosystem that the stablecoin operates on. Now let's talk about the second signal. And this one comes from valuation data that many people are overlooking. According to recent institutional analysis, the overall crypto market is currently trading roughly 50% below its long-term trend line when measured against the past 8 years of growth. When analysts mapped current prices across that historical range, the result placed the market around the 7th percentile. If you randomly picked any movement during the past 8 years of crypto history, there's roughly a 93% chance the market was more expensive than it is right now. That doesn't guarantee prices immediately rise tomorrow, But historically speaking, levels like this have often appeared near major cycle bottoms. Another data point adds even more context. Throughout Bitcoin's entire history, every investor who held the asset for a 4-year period ended up with a positive return. No exceptions. That's no speculation, that's the historical record of the asset class so far. Now combine that valuation picture with what analysts call seller exhaustion. During major corrections, weak holders typically exit the market first. As prices fall, those investors sell their positions, reducing selling pressure over time. After a large correction, in this case more than 60% from previous highs, most of the participants who intended to sell have already done so. What remains are longer-term holders who are less sensitive to short-term volatility. And when selling pressure slows down while new catalysts begin approaching, markets historically tend to transition from accumulation phases, and that brings us to the third signal: institutional movement. Some of the largest financial firms in the world are now openly discussing tokenization. Executives at BlackRock recently confirmed that the company plans to explore tokenizing certain financial products over the next several months. Considering that the global ETF market alone represents trillions of dollars, even small steps toward blockchain integration could have major implications for financial infrastructure. At the same time, large crypto infrastructure providers are already building systems designed to support tokenized assets and institutional settlement. Combined with evolving regulatory clarity and shifting attitudes within regulators, the environment that once slowed innovation may now begin enabling it. And there's another critical piece of this puzzle. The technology itself is improving rapidly. Cross-chain settlement systems that once required 15 minutes to finalize transactions have recently reduced that time to roughly 12 seconds, with ongoing research aiming for near-instant confirmation. For large institutions, faster settlement dramatically reduces operational risk and increases efficiency. When you step back and look at all these developments together, something interesting appears. Regulation is gradually becoming clearer, institutional infrastructure is being deployed, settlement technology is accelerating, and market valuations are sitting near historically low percentiles. Individually, each of these developments might seem minor, but together, they describe the early stages of a system that is still forming. And that's why the current moment can feel confusing to many investors. The data suggests long-term opportunity, yet prices may not immediately reflect it, but historically, price almost always follows structure, not the other way around. Institutions entering this space aren't making decisions based on tomorrow's candle or next week's volatility. They're positioning themselves years ahead, preparing for where financial infrastructure might be heading by the end of the decade. So, the real question becomes simple. Are you evaluating the market using the same long-term horizon as the institutions now building within it? Because when legislation, technology, and institutional capital begin aligning at the same time, the signals rarely appear loudly at first. They appear quietly underneath the noise. And those who recognize them early usually have the greatest advantage. If you enjoy content that breaks down the structural side of the market instead of chasing headlines, make sure to subscribe to STSA Smart. Every video here focuses on connecting the data, the infrastructure, and the long-term signals shaping the future of finance. And if you made it to the end of this video, comment "Runway" below. It tells me you're paying attention to the architecture behind the market, not just the noise around it. Stay patient, stay rational. The future rarely arrives suddenly. It builds quietly, piece by piece. And the people who understand that are the ones most prepared when it finally becomes visible.